This is TradeFlow News, bringing you relevant news and insights from around the world. TradeFlow News, enabling trade for SMEs and economies worldwide.
These are some of the key topics that we will be looking into in today's program.
First, let's take a look at the overnight headlines which are impacting the commodity markets.
10 European Union countries have called for the 27-nation bloc to ban imports of pipeline gas and liquefied natural gas, LNG, from Russia. A document seen by Reuters showed, as Europe debates fresh sanctions on Moscow over the war in Ukraine. The EU is preparing its 16th package of sanctions targeting Russia's economy, ahead of the third anniversary of Moscow's full-scale invasion of Ukraine in February 2022. The 10 countries, including the Czech Republic, Denmark, Estonia and Finland, want Europe to go further in targeting Russia's fuel exports, to cut the revenues flowing to Moscow.
Oil prices eased on Tuesday but remained near 4-month highs as the impact of fresh US sanctions on Russian oil remained the market's key focus. Brent futures slipped 28 cents, or 0.4%, to $80.73 a barrel by 0400 GMT, while US West Texas Intermediate crude fell 18 cents, or 0.2% to $78.64 a barrel. Prices jumped 2% on Monday after the U.S. Treasury Department on Friday imposed sanctions on Gazprom Neft and Surgutneftegas as well as 183 vessels that trade oil as part of Russia's so-called shadow fleet of tankers.
Moving on to the top news in the energy sector.
Chinese and Indian refiners are seeking alternative fuel supplies as they adapt to severe new U.S. sanctions on Russian producers and tankers that are designed to curb the revenues of the world's second-largest oil exporter. U.S. President Joe Biden's administration imposed its broadest package of sanctions so far targeting Russia's oil and gas revenues on Friday to give Kyiv and Donald Trump's incoming team leverage to reach a deal for peace in Ukraine. The U.S. Treasury imposed sanctions on Russian oil producers Gazprom Neft and Surgutneftegas, as well as on 183 vessels that form part of a shadow fleet that has so far allowed Russia to skirt sanctions to get its oil to global markets.
Investors are souring on the U.S. oil refining sector, citing forecasts for softer fuel demand and worries that President-elect Donald Trump may slap tariffs on imports of crude. U.S. refiner profits started to fall toward the end of 2023 as new refining capacity came online and margins returned to normal levels. This followed 2 years of bumper profits as refiners cashed in on supply shortages caused by Russia's invasion of Ukraine and a post-pandemic recovery in demand. Shares of major refiners have fallen this year, and on average, analysts have lowered expectations for refiners' fourth-quarter earnings before interest, taxes and amortization by 24% since the start of the quarter, Tudor, Pickering, Holt & Company analyst Matthew Blair said in a note. Next, we have the top news in metal market. Base metals were largely mixed on Tuesday with copper trading near its one-month high, although a strong U.S. dollar capped the gains. 3-month copper on the London Metal Exchange rose 0.5% to $9,138 per metric ton by 0337 GMT. The dollar hung near its highest in more than 2 years as traders scaled back rate cut bets in 2025 after data released last week showed an unexpected job growth acceleration and a 4.1% decline in unemployment rate for last month. The dollar index, which measures the U.S. currency versus 6 other units, was 0.1% higher at 109.54, as of 0337 GMT, not far from the 26-month high of 110.17 touched on Monday.
Iron ore futures rose for a fourth straight session on Tuesday to hover near their highest levels in more than a week, helped by lower shipments from key producers and top consumer China's robust steel exports. The most traded May iron ore contract on China's Dalian Commodity Exchange was 1.57% higher at 778 yuan, $106.14, a metric ton, as of 0214 GMT, hitting the highest level since January 3. The benchmark February iron ore on the Singapore Exchange traded 1.43% higher at $100.15 a ton, as of 0204 GMT. It hit the highest level since January 3 at $100.35 earlier in the day.
We will now look at the top news in the agricultural sector.
Russian wheat export prices have remained almost unchanged since the beginning of the year, with trading muted by the long New Year holidays and weak demand, while analysts expect shipments to fall in January. Dmitry Rilko, head of the IKAR consultancy, said the price of Russian wheat with 12.5% protein for free onboard delivery in the first part of February was $237 a metric ton, unchanged from the price in the last week of December. The Sovcon consultancy put prices for Russian wheat with the same protein content and delivery terms at $235 to $240 a ton, compared with $233 to $239 the previous week.
That is all for today's news on commodity markets. Stay tuned to TradeFlow News as we continue to provide you with more updates. We also invite you to follow us on Twitter at TradeFlow News, which allows you to watch our program on your mobile device or desktop to receive information from there.